Hello and welcome to our new video. In today's video, we will talk about the strange conditions in which, despite a fall in every economic indicator, like the GDP, jobs, industrial output, etc., the stock market is constantly making new record highs. To be able to understand this, we must begin by understanding the mechanism by which the prices of shares being sold and bought in the stock market are determined. The share price of a company is made up of many elements. First of all, there is the money that the initial investors, or promoters, invest in it. Once the company starts doing business, it starts making profits that accumulate over time. These contribute to an increase in the value of its shares. The company's record of dividends distributed to shareholders over its lifetime affect the amount accumulated, and the cash received by stockholders. The annual total profit of a company, divided by the total number of its shares, gives earnings per share, or the EPS. If the EPS of a company is 50 and its stock is selling at 250, then it is giving us an in-hand return on our investment of 20%. Now, if the prevailing return in safe government bonds or investments in solid banks get us 10% return, then it would be smart to invest in the shares of such company for the extra 10% return. This also make a difference in its share prices. When the company starts giving more capital gains, by the way of increase of stock price, at a rate that is higher than its peers, and there is consistency and certainty in these, year after year, the confidence of the shareholders grows further and the share gets a further premium in price. Further, if the future of the economy and the product of the company is bright, and the earnings are expected to grow at a faster pace, and if the management of a company, with its competence, transparency and good corporate governance, makes a good reputation in the wider society, then the shares of that company command a higher share price than other companies in the same business and market. However, if we analyze the information available in public domain, and from the news sources, we see that the per share earnings, or EPS of Indian companies, their sales turnovers, production figures, and all indices of the broader economy are deeply distressed, with further stress expected in the foreseeable future. Despite this, the stock market indices are continuously scaling record highs. In such a situation, if the share of a company is selling at 500, and its annual earnings per share is at 5, then our investment in that share is giving only 1% return, which is already low, compared to other available investments giving safe and assured returns. Now, if the economy is weak, and it is expected that earnings will decline, or even turn into losses, the price of that share going from 500 to 1000 in such conditions, will be difficult to justify. To understand this, we have to understand the fact, that when we create a market to buy and sell stocks and shares, as for example, a stock exchange, then shares do not remain just a part in ownership and profits of a business, but also become a tradable commodity, like a fruit, a car, or an onion, on which rules of demand and supply begin to apply. Using the example of a market, we can see that if 10 people go to market with 1000 rupees, where 100 kilos of onions are available, then the price is likely to settle around 10 per kilogram. Now, if there are only 100 kilograms of onions in the market, but there is a surge in demand, with a larger number of people willing to buy, who are willing to spend up to 10,000, then the price of onion is likely to increase, as some people would be ready to give up to 100 rupees per kilogram. This way, in addition to organic factors determining the price of a stock, which we discussed earlier, the prices of shares can be artificially manipulated by affecting the flow of money into the stock market. To know how this bubble is getting created in the Indian stock market, we have to get into knowing the sources from where the money flows into the Indian stock markets. The first group is general retail investors, who are not very influential in our economy. The next group is those of company founders or promoters, who cannot buy or sell their stake in large quantities and quickly, due to the rules and disclosures around promoter holdings. So, in the Indian context, these groups are not the most potent movers of stock prices. This brings us to people who affect Indian stock prices the most. The first among them are the foreign institutional investors, or the FIIs. When foreigners want to invest in India, they have very limited options as they cannot invest in a lot of asset classes. Also, foreign individual investors cannot invest directly in India. The foreign direct investment of FDI route is not popular among the smart money investors, who do not want their money getting stuck for a long period. This makes foreign portfolio investment, or FPI, the easiest and most popular mode for foreigners who want to invest in India for a short period. However, if we look at the recent past, on account of the structural weakness in the Indian economy, this kind of money has increasingly exited from India. If that is so, where is the big money pouring in from? This brings us to the Indian domestic institutional investors, or the DII, who are today the prime drivers of this anomalous growth in Indian stock markets. These include the mutual funds, the Life Insurance Corporation of India or LIC, and institutions engaged in banking, insurance and other financial businesses, as also funds, such as workers' provident and gratuity funds. The Life Insurance Corporation of India or LIC, was set up to provide life insurance and security, at affordable prices, to the general public. LIC used the premium received from the public, to invest at low interest rates, in giant schemes, under the 5-year plans, after the independence, which no other Indian institution, bank, or corporation had the ability to invest in, due to the huge scale of these projects. In its history, LIC has helped build dams, and create plants producing power, cement, metals, fertilizers and nuclear power, creating infrastructure and growth for people at large. LIC had also always invested part of its funds in the stock markets. The income from interest, dividends, and the growing portfolio was used to pay insurance claims and bonuses to the insured. LIC's money invested in the stock market, which was by 1990 around 64% of its investments, had, by 2017, increased to 99%. But, a bigger matter of concern was, that while in past, LIC's investments in the stock market were largely guided by commercial prudence. In a disturbing trend, in the last few years, large investments by LIC were made in the sinking government companies and financial institutions, under pressure from the government. Due to this, today, while on one hand, LIC is stuck with huge losses on investments, on the other hand, the price discovery of stock prices in the Indian stock market has been compromised to the extent that stock values today do not reflect the right valuations of the companies. The next big investors in Indian stocks are the mutual funds. While other organizations have to pay for money to invest, mutual funds are given a free and regular source of money to invest by millions of ordinary investors by way of systematic investment plans, or SIP. The average investor is neither bothered nor informed enough to understand that the shares on which his contribution is to be invested are already grossly overvalued. Mutual funds also cannot keep this constant stream of money flowing in the form of cash for too long, and have to eventually put it in the market, no matter how hot it is. According to the Reserve Bank data, assets under management by mutual funds, between 2018 and 2019, increased by over 2,500 crores of rupees, who were given this amount by public, to invest primarily in the stock market, despite a fall in the performance of companies, and the weakening economic prospects. According to RBI estimate, by the end of 2019, amount under AUM with mutual funds in India would be about 23,800 billion rupees. Provident and pension funds are also under a similar compulsion to invest their contributions in overvalued stocks. On the global level, we see the big money role played by governments and central banks directly. The ECB, and the US and Japanese governments, have all given bailouts and economic stimuli since the 2008 crisis. Lots of this money has flowed into equities and its derivatives. European Central Bank, despite being a regulator, has from time to time indicated that it may directly get into buying stocks from market. National sovereign funds, including the Vatican and monarchies, are also big contributors of flow of money into the stock markets globally. These deep pockets are fueling a global stock and related derivative price boom, which is not necessarily indicative of the health of the global economy today. To understand these mechanisms and machinations better, and to educate yourself on precautions you can take to be safe while investing in such investments, you can read the blog, When Your Mutual Fund Investment Becomes a Ponzi Scheme, the link for which you can see in the video description. If we go back to our example on onion prices, we can learn that the stock market situation is much more convoluted than any other commodity, on account of inelasticity of supply. For example, if there is an extraordinary increase in the price of onions, the supply can be increased by producing more onions or by importing onions, and in this way, prices can be brought back to affordable and realistic levels. These things do not apply to stocks. On Bombay Stock Exchange or BSE, which is over 130 years old, just a little over 5,000 companies are listed, while on the National Stock Exchange or NSE, which is about 35 years old, there are just above 1,500 companies listed. Many of these companies are listed on both the exchanges. Entry of new companies into stock markets are very few and far between. Among these less than 6,000 companies available for investors to trade in, there are a lot of companies, which are either shell companies, or inactive ones. This means that if a huge amount of money is continuously poured into a very small number of stocks, then the prices of their shares will continue to rise, no matter how weak the company and its business are. The situation becomes even worse when the shares of companies that have become hollow due to embezzlement and scandals caused by collusion of promoters and auditors, low-quality PF management and corporate governance, and incompetence of regulatory bodies like SEBI and the Reserve Bank are also sold at exorbitant prices. The problem becomes even more profound when we realize that, when we are told that the market went up or down, then they are not talking of any measure or index, which represents the change in prices of all the shares in the market. The information we are given refers to the Sensex or Nifty indices. The Nifty is based on merely 50 high-performing stocks traded on the NSE, while the Sensex only includes 30 high-performing stocks traded on the BSE. When a company's stock begins to perform poorly, it is kicked out of these indices. We are conditioned to believe that somehow, the change in the price of these handful and selected shares are a reflection of the changes happening in the stocks in the entire market. Just as by the high price of onions, we cannot estimate the condition prevailing for all vegetables or for the whole economy, similarly we cannot estimate the health of all companies, the market or the entire economy, by the movement in indices, comprising of a handful of Nifty or Sensex stocks. This is made amply clear when the rise in the indices is not matched by a change in the total capitalization of the Indian stock market. This indicates that we have created a bubble in the Indian stock market, quite like the property price bubble, fueled by subprime mortgages, that burst in America in 2008. The rules of economics postulate that this bubble too will eventually burst, to bring market prices of assets back at par with their intrinsic values. Just as a rising tide lifts all boats, however fragile they may be, so does an ebb ground the mightiest of ships. This brings us to the question, what does all of this mean? First thing that this state of affairs results in, is that the rate of return on the investments made in buying stocks and shares of companies becomes lower and lower. At the same time, the risk of sinking of the invested capital is increasing day by day, due to the bad condition in which the companies are, further compounded by the possibility of the recession in India deepening, on account of its own secular structural economic weaknesses. As a result of the overnight tanking of well-known, and reportedly well-performing companies, the wealth of the retail customers invested in stocks, and in the NAVs of mutual funds, have suffered, and are expected to suffer, further fall. For a large number of people depending on the LIC, provident funds, and pension funds, questions have arisen about their safety, and security, and their future income, and quality of life. When government supply-side policies help create and perpetuate these state of affairs, then surely there must be some beneficiaries. Who are those people? First of all, there are the owners of companies, who with the help of auditors, regulators, and business media, and the analysts and experts, pump up the value of shares. Then, by selling, or pledging, these overvalued stocks, the company owners accumulate large private wealth, and properties, all over the world. By the time the bubble bursts, they already are sitting on a big, golden nest egg, while other investors end up losing their shirts. The second group to benefit is smart money, or the institutional foreign investors, or FII, who move big money with speed, and by this strategy have the ability to make markets artificially rise and fall. They enter at the bottom prices, create a euphoria, and go out at a high, making big profits. When the dust settles, the small investors are the ones who suffer the most. While most helplessly watch, there are some who, falling prey to a junkie and a gambler's mindset, without understanding the reasons for the fall, pump in more money, and end up losing even more. Investors in mutual funds are even worse off, because mutual fund companies prevent them from withdrawing their money during bad times, by imposing lock-in clauses and heavy exit loads when they try to salvage their savings. This way, the helpless investor has no choice but to watch their investment and savings erode day by day. Now we come to understanding what can be done to ensure that there is a more robust price discovery mechanism, to ensure that the prices of the stocks stay close to their true values. Firstly, by lowering and enforcing the limits of promoter holding, the amount of shares available in the market can be increased. Next, a great number of non-listed companies, who have demonstrated potential and performance, should be encouraged to get listed in the stock exchanges, giving investors more options to invest, rather than being stuck with the very few number of currently listed companies. Further, direct involvement of small investors in the stock market should increase, without middlemen, like the mutual funds, so that investors can decide to sell or buy stocks according to market conditions, need, and at the time of their choice. With the increase in the quantity of available shares, the participation of a large pool of investors, who can enter and exit markets at their choice and level of comfort, helped, in no small measure, by effective regulation, will result in the stock markets getting out of the overwhelming influence of a handful of powerful players and speculators. The bigger question for an average investor is, given that structural factors are not in their control, how can the common man reduce their own risks and losses in such circumstances? By keeping a sense of balance, and using some tips based on common sense and prudence, one can save oneself from big losses. To start with, when it is observed that stock prices start going in the opposite direction, as compared to the performance of the underlying companies and conditions in the general economy, one should start squirreling away and building a firewall, for example, by selling 25% of your holdings every quarter, and converting your unrealized profits into cash. Using this strategy, part of your investment will gradually come out of harm's way, from completely getting lost. When the fall, referred to as a correction in the market lingo, comes, your pain will not be as much as it would have been if a large part of all your investment had been lost. The next thing that is worth bearing in mind is that the portion of your money that may be absolutely necessary for emergencies, or planned, or contingent needs, should not be put into an investments that may be subject to market risks. When the economy is growing all round, and one is reasonably confident of an increase in their own earnings, they should move towards high-risk, high-return investments, like the stocks and mutual funds, and, when the economy is in a downturn, one should withdraw money from such risky investments, and park them as more secure and fixed income-bearing investments. Like in a casino, the house always wins. In the stock market, the big players are the house. If the markets were a level playing field, the rich would never be in it. Just as the remora fish, that is able to thrive in the shadows of large predators, the small investor can also win, by using the game, by learning to take home the spoils of their small victories. Excessive greed also increases the possibility of losing everything. Thank you for watching. We hope you enjoyed the video. In our previous video, we had covered the supply-side trickle-down philosophy, which is behind the governments allowing, and even enabling, creation of bubbles like these. In case you have not seen that video, and want to check it out, we are giving the link at the end of this video, and in the video description below. If you like our video, please click the like button. If you would like to share this video with someone, please click the share button. To see more of our videos, please subscribe to our channel by clicking the button, and then click the bell icon to get notified. To give us your feedback, ideas, and suggestions, please use the section for comments below. Until later, have a great day.